Hi everyone, my name is Hannah. I'm going to be presenting to you over the course of the next 45 minutes to an hour. We've got quite a lot that we're going to get through, but there are still quite a few people coming into the room. So we're going to get started probably in about 60 seconds. We will be recording tonight's presentation. So if it glitches out or you can't stay till the end, because you've registered, we'll be sending you a copy of this presentation. If you've got questions and answers, you could just pop them down the bottom in the Q&A tab at the bottom. Just type your question in. That's going to pop through to my producer, Sarah, who's going to read through the questions at the end. We won't be able to give specific advice as to what financial products are going to be right for you, if that's part of your question. We'll try and keep the answers as general as possible so that you can apply it depending on your situation. We will get started in a few seconds. As I said, we're going to be recording tonight's presentation. So a little bit of a disclaimer. This presentation is general in nature. At Enable Me, of course, we give financial advice. We give regulated financial advice. Weirdly, not all financial advice is regulated, but we work in that space where we design the right strategy for you based on who you are and what you've got to play with and the hand you've been dealt to get you to your goals faster. But tonight I'm going to talk about the key principles, kind of the first principles that we apply when we're trying to design that strategy for you. So it's for informational purposes only, but of course you're going to be invited to have a consultation with one of our amazing financial advisors, but I'll cover that off at the end because there's a bit of a promo there. So tonight we're going to talk about the problem that we're facing. It's hard enough planning for retirement on a good day. It feels almost impossible to plan for it when you've got headwinds, when you've kind of got all these things that are outside of your control impacting your immediate situation and your future situation. So we're going to talk about the problems that we are facing. I always find that a problem called out is a problem halved because it allows you to work out what are the strategies that are fit for purpose for dealing with that problem. We're going to need to know what you'll need for your retirement, and that's going to be different for different people, but I'm going to talk to you about how you calculate that. Then we're going to look at, well, based on what you're on track to need, what are you on track to have? Because that gap is going to be something that we need to be answering or fixing for you. For many, that is the problem that you're trying to solve for. And when you've got economic headwinds, that problem becomes bigger. So you need to build in more margins, more buffer into those numbers so that you can combat that headwind, or as we like to do it at Enable Me, start to take advantage of that headwind. But you've got to have space to do that. So if your back is up against a wall, we have to first fix that so we can then kind of do a wind-up swing and try and kick something or hit something out of the park. We need to understand what are the options available to you based on the problem or the size of the problem you're trying to solve. The different investment options change depending on whether you've got not enough, or plenty for your retirement. So I want to talk about those and when it makes sense to lean towards one investment strategy over another. We're going to close that out. I'm going to give you some key takeaways. I'm going to go through some Q&As, and I know that some people have already posted quite a few questions in. We've tried to collate those into groups, but I'll answer as many questions as possible. And for those who are late to tonight's session, if you've got a question, just pop it in the Q&A button, and that's going to pop through to my producer at the end. So let's just kind of start with the grim reality. Most Kiwis are set to retire without a nest egg. The majority of us are not on track to have enough to fund our retirement or fund the retirement or the lifestyle to which we are used to living beyond when we stop working. We know that only 50% of the population is on track to be mortgage-free by retirement. And that's without even thinking or factoring in whether they're going to have enough after that. That percentage is going to decline. So what we know is that if you're trying to plan for your retirement, there are some key assumptions you need to have mastered to make the planning easier. The first one is that we need to know you're going to be mortgage-free by retirement. if you're not on track to be mortgage-free, we need to improve that outcome for you. That is one of the most important things you can do that serves the immediate you and future you. I had a client just this afternoon. They were 55, and I asked them, when are they on track to be mortgage-free? That was one of my starting questions. And based on the term of their mortgage, it was 15 years. What does that mean? Well, that means that they will have to work at their current income levels for another 15 years. That puts them at age 70 before they can think about retiring. This is on the assumption they want to continue to live in their house, because that's a lever that you could pull. But that outcome, they're not on track to make it as easy as they could for themselves. They're on track to make it harder. So we want to first fix that problem. And we were able to fix that because they had layers of inefficiencies in their spending and their money habits and how they structured the mortgage. When we worked it through, there were tens of thousands of dollars of inefficiencies. We were able to restructure that mortgage that was on track to be mortgage-free in 15 years. We could get them mortgage-free in 4 years. That materially changes their number, right? Instead of not having any savings and having to work till they're 70, we now have them being mortgage-free in the next 4 years. That gives them 6 years of saving without a mortgage. That's hundreds of thousands of dollars of difference. So we labor the point around you've got to have a really strong foundation when you're coming to plan for your retirement. And when we talk about a strong foundation, we are talking about your money habits. We're talking about your cash flow or your savings cadence. We're talking about how quickly you can pay off your mortgage, whether your KiwiSaver is optimized, whether your insurances are optimized. These all form part of your financial foundation. We want to get that as strong as possible because we need to start building wealth on top of that. Depending on the size of the gap we're trying to address, the more wealth we're going to need to create. Just to give you some updates on stats, we know that of those in the gap between 55 to 65, only 38% are on track to be mortgage-free by retirement. 79% of Kiwis don't know how much they're going to need for their retirement. And of course, the number differs depending on your situation. But as a rough rule of thumb, you look at, well, what does your lifestyle currently cost? Once, let's assume you're mortgage-free. How many years do you plan to retire for? What's the pension you're going to get? And the difference is what you need to have saved. So if I bring that to life, and this is true for an Enable Me client, it's an average, but most Enable Me clients spend $100,000 a year. That's what their lifestyle costs. And that's assuming that they are mortgage-free. Now, some of our clients can spend a whole lot less than that, and some spend a whole lot more, but 100,000 is kind of the average. If we're going to be retired for 25 years, that suggests that we're going to need to save $100,000 for 25 years, right? Which is going to be 2.5 million. But before I get to that number, I need to factor in that, yes, it's going to cost me $100,000 to fund my lifestyle, but actually I'm going to get a pension. I'm going to get a pension of around $20,000 for me and $20,000 for my partner. So that's about $40,000 a year. So of my costs, $40,000 is going to be offset by the government. So that leaves $60,000 that I'm going to be out of pocket by. So 60,000 times 25 years is 1.5 million. So that's the typical retirement gap that an Enable Me client would see or be confronted with before we look to improve their financial foundation. So I guess what I'm saying there, it doesn't matter what your number is. We're not bothered by the size of the number. It just indicates what strategies we need to apply, how quickly we need to get them to work, and whether we need to layer on one strategy on top of another. We know that 95% don't have a plan to make sure they will have enough for retirement. 90% of Kiwis run out of money within the first 10 years, and 1 million parents are helping their adult children. So at the time where they're trying to kind of get rid of them, they're required to sustain or support them in some financial capacity. There are 2 assumptions around retirement: that you are mortgage-free and that your children are financially independent. If either of those assumptions are not true or not as true as you would like them to be, we have to solve for that problem as well as solving for the retirement gap. And so we have some people that were on track. I'm getting to the solution, but I think it's important to call out the problems because we don't romanticize. It's not helpful to romanticize that things are cherry at the moment. They're not. But we need to know we're going to get you to your outcome in spite of that. Like, because this is what I tell my 14-year-old son, Cameron. I'm like, Cam, anyone can be good on a good day. And I'd say the same for your investment strategy. Any investment strategy can look good on a good day. I want to know how good it's going to be on a bad day. I want to know what levers you're going to pull to offset the things that you can't control to bring it within your control. So even if you were on track for your retirement, we know that the share markets have dropped 15% globally. We know that KiwiSaver is down 6 to 10%, irrespective of the fund that you're in. And house prices are down. And some people aren't sure when they think that the bottom of the market will be hit. I have a view on that. I think as soon as interest rates stabilize, which will be in the next 3 to 6 months, we'd expect house prices to stabilize because those two things are intrinsically linked. But we'll come to that. And we know that inflation is at 7.2%. So people who might already be on track for their retirement, they might say to me, well, why do I have to keep growing wealth? Why? I feel like I've got enough. And the reason why is to give you options. The options include being able to retire earlier, to be able to weather conditions in the market, and to be able to help your kids. That is why you continue to grow wealth. The more you have, the more you can afford to lose if the conditions aren't as ripe as what you want them to be. And one of the reasons why you've got to have more is volatility. I'm not so much concerned about the good times. I want to know that when the bad times happen, like right now, you would be pretty gutted if you had to withdraw your investments right now when the market hasn't bounced itself back, when you aren't able to get a premium for your house price, where you know that if you just leave the money in the bank, you're going to lose kind of 4 or 5% just because of inflation being higher than what you're going to get in interest. It's that volatility that is the problem. If you've got enough wealth or enough resilience, you don't have to pull the lever of cashing in your funds at the wrong time. Nobody cares about a down market unless you have to cash in at that point, because the market always comes back. If we look at the share market, I think since 1920, the share market has dropped by more than 20%, 17 times, I think, during that time. And I think in 16 of the 7 times, it's bounced back within a 12-month period. So the down doesn't bother us because it bounces back. We just need to know that you don't have to cash in when it's down. And that's when your plan, your resilience, your cash flow becomes really, really important. And you've got all these things that you could invest in. I'm going to get to what you need to be thinking about. But if we start at the top, you've got small company equities, you've got large company equities, for example, the share market. You've got government bonds. You've got residential property, that's that orange line, and you've got treasury bills. So that's the performance over time. You can see that they're all going up, but it's a bit of a serrated edge. That serrated edge is the degree of volatility. One of the reasons why people like property or treasury bills, not so much in New Zealand, we don't get too excited about treasury bills or government bonds even, but you can see that orange line where it's got the 47, that's residential property. It's going up, but the volatility is less dramatic than some of these other investments. So there are reasons why people invest in property. It's not just because of the return that you get, but it's because it's a less bumpy ride. And my experience is once you've gone through a roller coaster once, very few of us have the stomach to keep going through it. And as you get closer to your retirement, your willingness to have your funds kind of sweep in and sweep out, it feels uncomfortable. So this is a volatility piece that shows you that property is one of the most stable of investments, less volatility compared to other assets. Most commonly, we've got the share market and managed funds. less so in New Zealand, but you've got treasury bonds as well. So then we say, okay, well, that's one thing is volatility. What about the return? If you had $100,000, where do you put that money? And over a 10 or a 20-year period, how does that compare against other assets? Because you could put that money in the bank, you could put that money in a managed fund, you could put it in the share market generally, so you kind of have a hedged index fund, or you could put it in a specific share like Briscoe's as an example, or you could put it into residential property. Of course, there are other types of property, commercial property, rural property, but for the purposes of this example, we're using residential property. The red line, the red graph point is residential property. So for the same investment in each of those asset classes, over a 10-year period, property outperforms those other assets by between 250 to 300%. Now, that's not to say that property is the right answer for you, but if you've got quite a big gap, you probably need an investment type that is going to maximize the return for you relative to the amount of money you've got to start with. And the reason how that's possible is because if you had $100,000, you could put that in the share market or a managed fund. You could even put it in the bank. If you put it into property, you would take your $100,000 and that would serve as your deposit. You would borrow $400,000 from the bank and purchase a $500,000 property. So you've started with your $100,000 contribution, but you've managed to secure a $500,000 asset. Of course, you've got a mortgage against that asset. So any rent you earn is just paying off the mortgage. But over time, you're getting the capital growth. Despite only putting in 20% of the purchase price, you keep 100% of the gain over a period of time. That is what gives you the return. It's not property specific, it's the leverage or the benefit of the bank's lending to close that out. So I think it's important to understand that, yes, you can buy a property without having a mortgage. And as you get older, that's going to become more of the likely scenario for you because the banks are not willing to lend as much money to you at that stage as you progress past 60. It's not to say that they can't or they won't lend money, but the criteria they work within is very different than when you're in your 50s and certainly different than when you're in your 40s. So we need to first understand what is the size of the gap that we're trying to bridge to determine if leveraged property is going to be something you should be thinking about. Then we need to determine how long is that option going to be available to you. And it's not to say that you need to buy a residential investment property and buy Jingos. If you're going to buy one, don't buy a lemon. I'm very specific on what makes a good property. But if we know we need to do that, it's helpful to know the window of time we've got to pull that lever. And if we don't execute during that time, what does that mean? There are always going to be other options, but they're not necessarily going to be as tantalizing, exciting. They come with a grudge, with more of a sacrifice. So we try and minimize sacrifices generally. So when we're planning for retirement, we need to know the size of your gap, how much you'll need, how much you have now, how much are you likely to have, the gap between what you're likely to have and what you need. Of course, we want to improve what you're likely to have by strengthening your foundation. And in most instances, no word of a lie, that translates to hundreds of thousands of dollars of improvement in your retirement gap. So we're less concerned about what you give us in the first instance. We want to know, well, once we've followed our methodology, how sharp can we make you look before we worry about closing that gap? We do need to understand if leverage is an option and under what constraints does it remain an option? And if it's not an option, what are the levers that we need to pull? So when we start with, we first ask the question, is your retirement gap more than 300,000? If the answer is yes, could we reduce that gap by improving more, getting rid of the inefficiencies? The answer to that might be yes. And we might even be able to close things out just by things completely within your control without any wealth strategy. The reason we would continue to build a wealth strategy is we know not everything is in your control. The key assumptions are that you'll be able to continue to work at your current level and current income until you're 65. That isn't always an option for people. Certainly, if your partner gets sick, you might not be able to continue to work at that level, or if you get sick, right? That impacts what you're going to be able to save before you stop working. So you create wealth to give you the option that if it goes a little bit haywire, that you've still got enough to weather it. You also create wealth so that if your kids need a helping hand, you can help them without it being detrimental to you. And I like to create wealth because I'm pretty ambitious. I like to give myself the option of being able to retire earlier. And for any of my clients that I'm working with, that's something that we're trying to create as an option. Not so that we stop working. I think most of us intend to work, but we're able to work on things that are more of a passion project rather than the grind. And it allows you to consider leaving legacies, right? Excess wealth is not a bad thing. It can actually make your plan more robust. So we start with, is your gap more than 300,000? If it is, have we removed all inefficiencies and does it still remain at 300,000? If it does, or higher, then we usually need to consider using leverage, which is using the equity that you've got or your savings and looking to benefit from the bank's money when we buy an investment property. Now, there are a lot of things that we need to work through with that. It's not as fait accompli as, well, if I buy a property, therefore it's going to be okay. Those days ended about 20 years ago. We've got to be really specific around the criteria of the property that will work, how long we plan to hold it for, what we need to sell it for. When we sell it, what are we going to do with those proceeds? And how do we make sure you can hold it for the period of time needed to create the gain? It's about increasing the probability of you achieving what you intended to achieve, even in headwinds. And so it takes a bit of figuring out to work that through. As I said, if your gap is more than 300,000, we will use leverage to close it. If it's less than 300,000, there could be other options available to you that doesn't require you to use leverage. You may still choose to use leverage because it gives you more buffer, more options, or you might choose to invest in the residential investment property because it's a more stable investment compared to others. So of course, at the moment, you've got all investments not performing particularly well, but property is the least troublesome and has the least, I guess, serrated edge as it tends to grow, as evidenced in that earlier graph where we compared the different investment types. So when we're trying to strengthen your foundation, we are looking at what are the options for reducing your gap. We could, of course, spend less, which in theory means you should be able to save more. Doesn't always translate to that if you are a shopper. So there's certain things we've got to do to make sure that spending less or the sacrifice of spending less translates to better outcomes. Of course, you could pay the mortgage off faster, but you need to have money to be able to do that. So again, we need to maximize your savings cadence. You could earn more. But again, unless you've got the right structures, the right systems in place, putting more money in at the top of the bucket, if you've got holes at the bottom of the bucket, doesn't translate to much. But these are things that you could be looking to do. You could, in fact, be looking to work for longer than age 65. You could get a second job, perhaps. Well, it sounds horrific, but these are options. You could invest in non-property assets, or you could invest in property assets. You could get your children financially independent faster. These are all options. You could even consider downsizing your home. These are options. The more options you have, the better. But before we look at the investment options and kind of some of those dramatic scenarios of downsizing homes, I just to put some context around your effort. For every dollar we can save you, i.e. that you'll increase your savings by, if we can put that against your mortgage, that will repay $1 of mortgage and it will save $1 of interest you won't have to pay back to the bank. We then, because we've paid off some mortgage, we've created equity. We're going to use that equity, usually borrow against that to purchase an investment property and get the capital growth on that property. Those three layers create a $10 return for the $1 of effort. And that's what you want to do. I was talking to a client earlier this week and I said, look, she was kind of itching to make some sacrifice. And I said, well, it enabled me where if you want to make sacrifice, that's cool. But our rule of thumb is make sure you maximize the return you get for that sacrifice. Inconvenience without a good enough return, in my mind, is just a whole lot of faff. And like you, I don't have time to waste on faff. I can put effort in, but tell me what I need to focus on that's actually going to make my boat move faster. That's what I need to know, and that's what our clients need to know. If you've got a 30-year mortgage, this is relating to that number 23. If you've got a 30-year mortgage and you're paying that off consistently, of your monthly repayments, you pay a portion of interest and a portion of principal. I thought it would be at year 15 that you start paying more principal than interest within your monthly repayment. It's not actually until year 23. So not only are you going to pay the bank back, you're going to pay them the interest from that loan first, essentially. So we need to stack the odds in your favor. And often that means an overhaul or a relay of your financial foundation. We all tend to be a little inefficient across all these areas. Now, if you've already got property, the next question we need to ask is, well, are your properties still the right properties to hold? That they could be, but often we find that properties serve their purpose and then they need to be replaced. They need to be replaced with better performing stock, newer stock, higher yielding stock. I've got many clients that have owned a property, and with the new tax rules, with the new lending rules, the cost of continuing to hold an existing property rather than buying a new property can translate to a difference of $30,000 a year in increased hold costs, simply because one property is new or not. So we want to assess each property, each component of your wealth on its own merits. And if any form of investment, whether it's your managed funds, whether it's your direct investment, whether it's your property portfolio, if it's not performing to the level it needs to, then we need to seek whether we replace it and what do we replace it with. And for those who don't have a property, maybe your assets are split across other non-property assets, is now the time to try and diversify your property portfolio or your wealth portfolio with property. There's no right answer to this. These are just things that we're working through. Now, as I said, if you've got other investments, we want to review your portfolio. How is it returning? Of course, in the last year, it hasn't returned, no one's really returned much. So let's look historically, how has it performed? Let's understand the opportunity cost between that investment and a different type of investment. Then let's compare historical averages. Let's look at the diversification, the costs involved. Let's understand the exposure to overseas markets versus the New Zealand market. We don't mind if we've got to replace things. We don't really have an emotional view. I know it's uncomfortable when we point out that a property isn't performing or an asset isn't performing as well as it could, especially if you knew that, especially if you had persuaded your partner to buy said asset. I understand that's uncomfortable, but let's not throw good money after bad. Let's assess it on its merits and work out, well, if we kept it, what is that going to do for your future and your short term? So the short, medium, and long-term financial implications versus if we replaced it and what the differences we could replace it with. Whether we sell a property to replace it with a managed fund, whether we sell a property to replace it with a different type of property. There's no right answer, but there is a specific problem that we are trying to solve for. And these levers are either going to be pulled in the right order to solve for it or not. And our job is to try and increase the probability of that outcome for you. Sometimes you've got to liquidate assets to build your resilience so that you can weather the conditions of the day. That's okay as well. We just need to know that there's a plan to either reinstate things or to adjust. Again, I guess I can't stress this enough. We're here to increase the odds of you getting to the end goal with what you needed to get there with. How we think we might do that in day one is often very different to what we're doing on day 100 or day 500, because life throws opportunities and obstacles in our path. Some of them we anticipated, some of them are a complete shock. Not all of them are bad, but all of them cause us to pause and work out if the strategy we were applying is now fit for purpose. The more often you could revisit that strategy without emotional kind of attachment, the more likely you will be able to achieve your goals. Now, if you've got money in the bank, well, that's a bit of a stink, isn't it? Because we've got this wretched inflation. So what that means is if you had $100,000 sitting in the bank with a 7.2% inflation rate, at the end of 12 months, that's now buying you $93,000. You've literally just burnt $7,000 of that investment simply because it's sitting there doing nothing. So again, when we're comparing the different asset strategies that you could apply, yes, we could keep it in the bank. Yes, we could put it into managed funds or equities, or we could put it into property, and that could be leveraged or not, or it could be residential or commercial. There's so many different combinations. We have to come back to what is the problem we're trying to solve for your particular situation. How helpful are the banks going to be, which will depend on your situation and whether we can get you bank ready, and how strong is your foundation for us to be able to build at pace. And we don't bother building until we've really strengthened that foundation. If getting the efficiency squeezed out isn't going to be enough to solve the problem, and for most it's not, well, the option we've got is working longer beyond 65. Some people tend to think that they will, but the reality is you just don't tend to work for as long as what you thought you were going to, and very few people can maintain the income level that they were making, say, before they're 60. It's not that it's not an option, it still remains an option, but it's just not as, it doesn't shake down to what you expected. Of course, you can downsize your home. On average, that buys you an extra 3 years of retirement. Not normally enough. There are reasons for that, but I guess how we view your home is it's kind of your get out of jail free card. You don't want to play that prematurely. The longer we can hold, the better, usually. That's not always the case. Of course, you might get an inheritance, although it can be a bit weird factoring in inheritances when we're planning your retirement. And my experience, but if we're desperate, we will. My experience with inheritances, though, is that people don't tend to die at the right time. So you do get something, but it's not usually at the time that you needed it, where it was really going to be helpful. So I've got some clients that in 20 years' time, yes, they are expecting some inheritances. So their long-term view is looking really good, but the next 20 years is looking pretty sketchy. And they're not going to be paupers during that time, but it's going to be a pretty uncomfortable ride unless we are more deliberate with how we amass wealth in the meantime. Of course, if you're self-employed, you could look to sell your business, although that's easier said than done. And normally you need a good 2 to 3 years runway before you do that if you're going to try and maximize the value that you can translate. And again, you could spend less in retirement. Practically, though, for the first 5 to 10 years, we find that people spend more in retirement rather than what they were spending prior to retirement, because that's often the time where you've got the time and energy to travel and to do things that you wouldn't necessarily have had the luxury to do before you retired, and it has a cost attached to it. But again, we've just got to design the plan for you and what's important to you. We've got to adjust your strategy. So we always adjust it for your cash flow needs. That's often referred to as your liquidity. We have to adjust it for your kids' needs. We have to adjust it for the return you need versus the return you're comfortable with. Those can be two different things. And also the volatility your cash flow and your overall situation can absorb. These are the things we're trying to work through. So when we work with our clients and we're planning for retirement, some clients start planning in their 40s, some arrive at us at 65 or 70. It doesn't really matter when you arrive. Our job is to make sure that with what we've got to play with, we are maximizing what you've got to stretch it for as long as possible. It's never too late to improve where you're going to end up. This is a bit of a segue, but there was this sort of headline from 2009 that a daughter mistakenly throws out their mum's old mattress stuffed with $1 million. I have a client that did that in the COVID, when COVID went a bit crazy and people thought it was going to be the end of the world and all of these things. And she withdrew, I love it, I love this client. She withdrew $800,000 from her managed fund, or it might even have been the bank. And I said to her, what have you done with that money? And she said, well, I withdrew it. And I'm like, well, what did you put it towards? She said, well, I actually put it in a box under my bed. And I'm like, oh my word. So we all do crazy things. We've got her back where she needs to be. But look, when we're trying to plan for retirement, we take into account the levels of spending and how those change. And they normally change. You've got the first 5 to 10 years where you spend your most, then it starts to reduce. And then in your final years, of course, you're spending a whole lot less discretionary spending. But for many of us, our discretionary spend only accounts for 20% of our outgoings. So yes, your discretionary spend starts to reduce, but even in reducing that or cutting it out entirely, you still have quite a lot of fixed costs, and those costs don't necessarily go down with age. In some situations, like health insurance and general insurances, they actually increase with age. You've got your rates, which seem to increase more than inflation. You've kind of got all these other costs that you are absorbing. And so this belief that your lifestyle will suddenly cost a lot less doesn't really translate to reality. But we like to work that through. When you've only got 5 to 10 years before you need an investment, you tend to invest in lower risk options where there's less volatility, because you need to know that when you do need to take that money out, that there's a lower chance that it's dropped its value by all that much. When you've got a longer horizon that you're planning for, and this is why when we model, we're trying to work out what are the milestones we need to be releasing capital by. When you've got a longer horizon, you can afford to invest in medium-term investments, medium risk. And the longer the horizon, the more risk that you can afford to take. Now, whether you are comfortable with that level of risk, well, that's part of you understanding what do you need to achieve your goals, because some people will default to saying, well, I don't want to take much risk, which I understand. But if not taking enough risk means that you're not going to achieve your goal, that creates another type of risk, right? So you've got to understand how it relates to you before you decide what level of tolerance you're prepared to accept. As you move through the stages of retirement, we look to change your split or the spread of wealth assets. So to start with, if we've got a retirement gap, your wealth assets tend to be weighted 75% towards leveraged assets and 25% to non-leveraged assets, which tends to be non-property assets. Once you hit retirement and you know that you've closed that gap, you can move to more, you can try and reduce the risk or the volatility. So we'd move more to a 50-50 split. And when we know that you've retired and we've got 10 years of certainty and we're cashed up, your need for leverage starts to reduce. So you might only have 25% of your overall wealth assets with a mortgage, 75% without a debt attached to it. The 75% might include property, but it just wouldn't have a mortgage on it. Now, for those who want to plan to leave a legacy to their kids or to their wider family, we encourage you to fix your own oxygen mask first. So let's do it once we're sure that you're going to be okay. If you are going to be lending money to kids, we need to set expectations around that. Where possible, we try and overlay closing out your retirement gap with helping the kids onto the property ladder, if that is part of your goal. So we're quite selective with how we do that, but we have to include the kids in your overall wealth planning, even if you don't want to give money to them, or you don't intend to, knowing that you've got enough buffer there so that you could help them if you needed to becomes really important for determining the volatility you can afford to absorb. Of course, when it comes to protecting your assets and protecting your plan, protecting your assets, you tend to use a trust, especially if you're going to be lending money to kids and their partners. We would encourage you to have specific loan agreements so that the money that you do lend to your children doesn't inadvertently make its way to relationship property and then get split with their spouse when their spouse leaves them. And we also want to get insurance policies in place. I'm going to take some questions in a second, but the key takeaways before you do anything, take stock of where you're at, where you need to be and what the gap is. And if that is overwhelming or you're not sure if you're going to be able to diagnose that accurately, let us diagnose that for you. And then let's give you some suggestions on how you might close that gap. And those suggestions might be really empowering and exciting, or they might make you feel nervous. So let's understand, well, if you did something versus not do something, does that materially change where you're going to end up? The strength of your financial foundation will determine the growth you need. The stronger your foundation, the less growth, the less wealth, the less risk you need to take. But let's spend time strengthening that foundation. The size of your gap will determine the plan of attack. If your retirement gap is more than 300,000 once you've squeezed out the efficiencies, well, then we're probably going to have to use leverage if that is an opportunity. Now, I've had some clients where we've had to take almost an unorthodox view of how we're going to do things. An example where they needed to use leverage, but they couldn't afford to use leverage. So we had to rejig how we were going to position themselves. In their situation, they actually ended up renting a property themselves. So they moved out of the family home so that they could unlock the equity in order to buy another property. Of course, this was a short-term fix, but it was a fix that ultimately solved their problem with a little bit of inconvenience. Now that solved hundreds of thousands of dollars size problem. That's the example of, if we are going to sacrifice or adjust or inconvenience ourselves, let's make sure we bank it. Otherwise, why would we bother? We want to make sure your investments are working as well as they can for the current environment. That's not to say they haven't served you well, but where we're at now, are they the right mix? And good plans should be assessing that every year. We need to make sure that when you retire, you reset your strategy again. And often in retirement, we tend to work with our clients. We get the plan in place. We're checking in every 6 months to make sure that there hasn't been changes in their situation and that the investment strategy remains fit for purpose. I'm going to take questions after the slide, but for those who aren't yet an Enable Me client and who are wanting to grow wealth, but do it in a really tactical, smart way, then we would love to help you understand the size of your problem or the size of your opportunity. Come along to an initial consultation. It's normally $400. It's discounted to $250. You just pop to enable.me/wealth. In that consultation, we're going to diagnose your situation, analyze your opportunities, recommend a suitable program or a piece of work if we think we will be able to help you. If we can't help you, if we think that you're already on track, we're going to give you the tick, and that's going to make you feel good as well. But let's take control of something that can actually be quite overwhelming. That's what we want to do, because that brings peace of mind. It creates options, and options create security. Now, I'm going to take some questions. I have seen a few have popped up below. I'm going to pass over to Sarah, who's going to whip through some of those questions now.
Amazing. Thanks for that, Hannah. We had a question come in live. How does the recent tax and other changes alter the traditional returns on property investment?
It doesn't really, it alters the returns on an existing property because the hold costs are significantly higher than what they would be on the same property if it was new. So it comes down to setting the property criteria. I don't advocate for buying an existing property. I always advocate for buying new. And there are many reasons for that. The tax is certainly a reason as well, but it's not the main driver. So for example, on a new property, you only need a 20% deposit versus a 40% deposit. On a new property, you don't have repairs and maintenance for 10 years. On an existing property, you do. You tend to attract a better quality tenant. I like that I give my tenants really nice, healthy homes. I love that. And I love that I can create that for these families. I also know that because it's a healthy home, I can charge a premium for my rent if I decide to. It means that interest costs are tax deductible. And for at least a 5-year period until we're outside of the bright line test, I'm going to be holding that. So my hold strategy needs to be really important, which then feeds back into my financial foundation, because that's what holds the wealth strategy. But a new property tends to always be the preference. So these rules that have come in are odd, you know, like with the deductibility. That deductibility doesn't apply to new builds, and new builds also only have a 5-year bright line versus a 10-year bright line for an existing property. So yes, there are things that we need to take into account, but it tends to be captured in the property criteria that is set for you based on the rest of your situation. And in that criteria, we're going to say, well, this is the capital growth we need from this property in order to solve your problem. Based on that growth rate, that's going to narrow down the regions that would be suitable to give us that growth rate. It's also going to narrow down the types of property we would consider within those regions, the yield, the number of bedrooms, all of those things feed into that property criteria. There are many properties on the market. I would probably say maybe 1 to 2 to 3% would be suitable for you if we're trying to solve that problem.
Awesome. Thanks, Hannah. We have a question here about Auckland housing yields. They comment that they're quite low at the moment. What is your position on this when it comes to property investment? Yeah, so
you make money, you tend to make money from the capital growth on a property rather than the yield, which is the rent. And there tends to be an inverse relationship between those things. The greater the capital growth potential, normally the lower the yield. The lower the yield, the higher the hold cost is to you. From my perspective, the higher the hold cost, the less likely you'll be able to hold it to get the gain. So they're all kind of intertwined. But typically that observation is correct, that properties in Auckland tend to have a yield in the 2s. In fact, most properties around the country probably are in the 2s or 3s. When we're looking at property, we're looking at a yield between 4 to 5%. Is normally what we need. If we can get higher, we try to, but it's hard to get that on a new property. If you're looking at buying in Auckland, you tend to be more in the outer suburbs to do that. So that's your Pookies, that's your Warkworth, different areas. But investing in Auckland isn't necessarily the right thing to do, and not everyone can afford to buy an investment property in Auckland. So we have to first kind of work backwards to, well, what is the growth we need? So therefore, what are the regions we should consider, which could include Auckland. But then what do we have to spend? And I'd much rather have a 4-bedroom standalone property in Christchurch than a 2-bedroom apartment in Auckland. Right, they might have the same yield, but I believe they would have different capital growth projections. So we have to start comparing these properties against each other and look at, well, what is the top up required from you as the owner, and what is the potential capital growth? And investing in Auckland certainly isn't a prerequisite to creating wealth. In some situations, the lower the yield, the harder you make it for you to actually bank that wealth.
Very comprehensive answer there. We do have someone who's just sort of counter questioned, or like this has prompted a question, and they're asking, with new builds, do you see increased risk at the moment of developers going into liquidation or delaying builds?
Yes, I do. And so you need to be able to mitigate that. There are a few ways that you can mitigate that. I like to do land and build contracts when we go through this stage of the economic cycle, because you are only paying for what's happening or what's being delivered to you. You're not giving them money in advance. So that means that the builder isn't having to manage money and you're in control of that process. So that de-risks that process rather than a turnkey scenario where you pay a deposit and you don't pay anything to the end. Now, of course, if the period of time between you securing the property and settling on the property is close, then that's not so much of an issue. But we only work, we've kind of got about a 25-point criteria of the types of builders or developers that we work with. So they have to, it's not to say that builders that we don't work with are bad, but we have been around the block quite a few times with these builders and have worked through some pretty challenging times in COVID and feel very comfortable with our building partners that it's not that we personally use, it's actually that our property team work with, which is a separate entity. But yes, there's risks, there's absolutely risks. And so choosing the wrong property is a risk, choosing the wrong person to build the property is a risk, choosing the wrong type of financing of that property during the build is a risk, having the wrong hold strategy to get the capital growth out the other end is a risk, and the economic cycle and political cycle is a risk. So those are the things that we call out, and for each thing there is a way that we will mitigate that risk. Probably the biggest risk in my mind is you. Our clients tend to be the things that can make or break a plan, right? So we've got to get the right systems and scaffolding and infrastructure around them to increase the odds of the plan being able to be executed safely and successfully.
And that is one of the biggest benefits of working in with a coach, isn't it? It's that having that confidence building person in your corner.
Yeah, I think often you've got to make big decisions, and you have to be brave to make those decisions. Most of us get our confidence when we can, or get more confidence working with someone who's not emotionally involved, who is understanding or explaining the short, medium, and long-term implications of following through with that action or not, right? Because inaction has quite a big cost at the moment with inflation at 7%. If you want to leave that money in the bank, as an example, we'll just burn 7% of it, because that's the equivalent of what you're doing. So it's not to say that you need to rush out and do anything, but you need to understand objectively what your options are. And if you were to sequence those differently, what does that mean? And I think a really good financial advisor can articulate that for you, and that gives you the confidence to act. A lot of people know kind of instinctively they need to do something, but most people don't do anything, as evidenced by the statistics right at the start, right? Most of us don't know what we need for retirement, and even if we did know, we're not on track to sort it out. And that's knowing that we need to do something. It's no one's trying not to be financially responsible. I think knowing and doing are two very different things. And I think the idea of having someone in your corner calling you out, and sometimes calling your spouse out on inaction or how you're looking at things isn't quite right and it's impacting your perspective, that's invaluable. That is really invaluable.
Awesome. Thanks, Hannah. We've got time for one more question, I think. And this one is, as I age, one of the financial risks I face is my health. How do I plan for this risk?
That's a really good question. So I guess it depends on the age. In the short to medium term, you normally offset that with insurances. That's how you protect your health. Not health insurance, although that might be a form. It's more that if your income was to drop because of health, that normally is a problem to your financial plan. So we've got to be able to work through that. Yes, insurance can protect it, but the best way to protect it is actually by start growing your wealth so that you're going to be okay even if your income or health deteriorates ahead of plan. That's an example of why excess wealth can serve you. What I can say about insurance, because insurance is one of the building blocks that firms up your foundation. As you build wealth, your need for insurance should start to lessen or lower each year. So a good insurance plan or an income protection plan, whatever you want to call it, should be reducing as you proactively build your wealth. And yes, it's comfortable to have insurance, but it is more comfortable to know you don't need it. Not because you have your head in the clouds and believe that life won't give you a curveball. I kind of roll my eyes a little bit to that. You don't need it because we've got enough, even if things don't go to plan. That is financial success right there, that you're going to arrive, whether the winds of change are on your side or not, you're going to arrive where you need to, and you're going to live the quality of life you need to or deserve to. And if you need to help your kids, you can, and it's going to be okay as well. That is financial success. But for those who are brave, come in for that first session. I promise you it will be a relieving process, and usually it ends up being fairly empowering. But for those who have joined us tonight, thank you for having me. 2023 is going to be a very good year, so we hope to enjoy that with you.